It looks like the bottom is in. All of the altcoins are going up. It's not just the altcoins, Bitcoin, Ethereum, etc. as well. It seems like the crash is over. In this live stream, we are trying to cover this. We're trying to figure out what's actually going on. And is there potentially a bottom of this bear market that's lower than the current levels? Or is this it? Are we going to go up from here? Let's have a look at all the data. And again, welcome over here. Feel free to enter your questions in chats. Let's have a dialogue. Let's figure out what's going on. So this is Bitcoin. Bitcoin has crashed on February 6th. It went all the way down to 60K. Then we've got recovered. We got close to 70K. We got back down. And it seems like now things look good again. Right? Was this the bottom? Should we now buy? Is the reversal in? There are several different models to have a look at. This here comes from the recent Glassnode newsletter. And it gives us different reference prices, the short-term holder cost basis, for example, or the true market mean, but all of those supports had been broken. The only support that's still standing is the realized price. Now, the realized price is still not, we are nowhere near the realized price. And we actually look out and we check charts from this website here, Bitcoin Magazine Pro. We've got all kinds of interesting models that we can take for reference. And it gives us the balanced price, the realized price, all kinds of potential indicators that tended to work well in the past. So the balanced price is a price that looks at how did Bitcoin move based on its mining activity. And here we've got a potential bear market bottom of 40K. In the past, we just briefly hit the balanced price. So it tends to be a good indicator. The only issue with it is that sometimes it also tends to go down. So it's not necessarily the absolute bottom. This indicator is also now currently trending downwards. But in general, if we fall quickly enough to hit that balanced price, it might make sense to buy quite aggressively. But again, we are not there right now. The issue again is that this price every now and then slightly goes down. This is different to the CVDD, so the coin value days destroyed bottom indicator. This monotonically increases. It never goes down, right? The balance price every now and then goes down. The CVDD does not go down. And this indicator gives us a potential bear market bottom of 47K. So if this indicator it doesn't break, if you continue to stay on our general structure, then we should be bottoming out at 47K, not at our current price levels. What's actually interesting is when we measure the cycle top from the bear market bottom in the past, we tended to see declines of 90, 80, 70%. We never saw a decline of only 50%. And it seems like if we now turn around already, if this was the absolute bottom, that would definitely be out of the ordinary. This is not what usually happens. Let's have a look at a few comments. Just one question. Tell us about gold today, please. I will do that. I've already prepared some charts around this. Such relaxing music before we get hammered with terrible news. Yeah, yes and no, right? So it seems like short term we have stabilized, but over the next months I am still quite bearish, and I will also show other indicators besides just those bottom indicators that paint a not so pretty picture, unfortunately. An update about Pippin. I've just made a video on Pippin 2 or 3 days ago. The fundamental stance on this has not really changed. Most of the supply of Pippin is held by a few whales, by the network that launched Pippin, and the problem is that Pippin might get manipulated via the perpetual futures on Binance. At 40 to 50K, aggressive dollar cost averaging, yes, I agree. I think the 40 to 50K range is definitely very attractive. Okay, Gerhard, my questions never match the video topic, but during market, why not use leverage for shorting in moving average strategy? I think you said 2x is optimal in both directions. Your thoughts? Yeah, we can get into this in a second when we talk about the moving averages. Let me show you some data around this. I put this in my list of things to discuss. So virtual 7929, thank you very much for the question. Very much appreciated. Let's directly jump to the gold question. So what about gold? Is gold now too expensive? Is it potentially a good diversifier? We bought gold and silver roughly 1.5 years in premium because it was relatively cheap. So when we compared gold to other measures, when we compared it relative to the money supply, when we compared it relative to stocks, gold tend to be cheap. And the nice thing about gold is that it's not correlated to anything else. So it doesn't go up or down with the rest rest of the market. If the stock market crashes, gold can go up. When the stock market appreciates, gold can still go up. Gold also doesn't move in line with Bitcoin. And so if you want to have a diversified portfolio where things go up and down at different points in time, but long term they still appreciate, if you want to reduce our overall risk in the portfolio doesn't fluctuate that much, then gold is a good diversifier. At least it tended to be a good diversifier in the past. In the past, it very much looked like it was cheap. But that has changed with the recent rally. Have a look at this. This is now gold relative to US money supply. And this is a very long-term chart. So it starts in 1959. This is where our money supply data starts. So what we have over here, the dotted line, that's the average ratio of the gold price relative to the monetary base. And based on this chart, gold does not look cheap at all anymore, right? If it was to go down to this potential equilibrium price, it could fall from here by roughly 47%. Now, how could it fall by that much? It could fall by that much because the price is going down or because the monetary base expands. But the monetary base doesn't expand that quickly, right? It goes up by roughly 6.8% per annum. And so this drop over here would imply an expansion of roughly the next 10 years. So really, the main driver for this to come back to equilibrium would be the price itself going down. Now, what I believe when looking at this chart is actually that this dotted line, the equilibrium price, overestimates how well gold long-term does. And that's because gold has no fixed supply. Gold also gets mined every year, right? It expands by roughly 2% per annum. That's the new supply that hits the market every year on average. And so when something expands by 2% per annum, we shouldn't expect that versus the monetary debasement, it keeps completely its value. We should rather expect that when the monetary base expands by roughly 7%, a bit less than that, right, 6.8%, and when gold expands by 2%, that then gold in fiat terms should appreciate by roughly 5%. Right, so 7% because of the devaluation, less the 2% that gold itself expands, so 5% of appreciation in US dollar terms year over year. We should not expect that the gold price expands by the 6.8% per annum. So when we look at this chart, we should not expect that this ratio stays stable. Rather, gold should underperform USM2. Now let's take this peak over here, maybe not the very top peak over here, but this one over here. And let's see how much so far it has gone down compared to the current prices. The answer is 49%, roughly 50%. That's over the course of 46 years. Let's calculate what kind of depreciation should we expect over 46 years if gold was to underperform on this ratio by 2% per year. So we take our 2% per year and we take this to the power of 46 years. What do we get? We get an expected remaining value of 39%. Or a loss of 60%. We have seen a loss of 49%, maybe when we take the tip top to the current price, a loss of 59%, and that's pretty much exactly according to our expectations. So if we were not to align the gold price chart with the US money supply, but actually the gold market cap, where we don't have the data unfortunately here in TradingView, but if we were to align the gold market cap relative to the market cap of US fiat currency, then the peak that we've seen at the beginning of the 1980s and the current peak, they would perfectly align. But the reason why they don't perfectly align here is because we compare the gold price versus the monetary base. But actually, gold devalues versus the monetary base, at least that's our expectation, by 2% per annum. And so those two peaks on the market cap chart would align perfectly. And so what does this tell us? It tells us that I don't think that gold is necessarily that great of a diversifier again. I do think that gold is rather expensive. The problem also with buying gold right now is that if we do not time the market right, if we just buy into gold now and then we want to wait it out, quote unquote, that we then have to wait for a very, very long time, potentially forever, to get our purchasing power back, right? If you bought in the 1980s and you just went on this whole train, right, you bought the hype, you never got your purchasing power back relative to monetary debasement, right? You would still need more appreciation. And that would then mean a new all-time high of gold relative to USM2. Now, what we are implying here with this analysis is, of course, that the financial system is not going to collapse, that the US dollar will still be relevant, that America will still be one of the most important powers in the world, that nothing fundamentally is completely going to shift. And that's, of course, potentially a strong assumption because the US dollar, for example, isn't used as a reserve currency that much anymore. anymore. So there might be some kind of a power shift, and it might be true that whatever replaces the US dollar potentially could then also be backed by gold, and that of course would support the gold price at that point. But what this also means is that what we see here on this chart is pretty much the maximum we can expect in gold appreciation if the global power dynamics were not to change anymore. If the global power dynamics stay the way they are, then gold right now, I believe, is extremely expensive. And I don't think it's a great time to buy gold right now at those levels. Unless, of course, you just buy a hedge. If you buy a hedge in your portfolio with a small percent, right, with like 2, 3, 4, 5%, a hedge against the general market collapse, that you've got at least some purchasing power in case everything comes crashing down. And of course, buying gold might make sense. But if you're now buying gold just for price appreciation to jump on the current momentum, I think that's very dangerous. I don't think that's the right thing to do. Okay, let's have a look at a few more questions. I hope this was useful. Let me know what you think about this as well. I'm Crypto Shield in Telegram. Can't believe I made it into a live. Keep up the good work, sir. Thank you, Mastercraft. Thank you, Crypto Shield. Nice to see you here. Today, I've just entered a long on gold and a short on silver. What's your thoughts? I'm not really a fan of trading the gold to silver ratio. The two assets are very different. The same as Bitcoin and Ethereum is very different. Silver tends to have a bit more supply expansion over time. This is now gold relative to silver. And yeah, if you're shorting silver and you're long in gold, you're basically betting on a bounce over here. But we're still very close to the equilibrium price. So it's unclear. I'm not really sure if this is the right thing to do. The volatility on that ratio is relatively erratic. It's not that big. I'm not trading that pair. I don't think it makes a lot of sense. There was this idiosyncratic rally in silver that also has now come to a halt. I've talked about this as well. The picture in silver looks very similar to the picture in gold in terms of its valuation relative to the money supply. One more chart on gold here. This is gold relative to the S&P 500. It also tends to rather underperform. That's because the S&P 500 tends to keep up with monetary expansion, while gold tends to underperform. And yeah, I do not think that the risk to reward currently is worth it. Gold has only been more expensive at the end of the 1980s, and really betting on another extreme bubble to occur, I think, is not it's not very wise, right? It's not the most likely thing. What is the minimum investment amount for the copy trading pool? We're going to talk about this in a second. Let's say at the end of the stream, rather. I'd recommend to have at least $10,000 in crypto in general to invest, and then the maximum to put into the pools, maybe 50% of that, because you still want to be diversified and own some Bitcoin, say native Bitcoin in general. And the copy trading pools do still have some risk. They have platform risk, they've got mispricing risk, right? Like on October 10th when we saw the flash crash, there are some risks with perpetual futures that are even beyond our control, where, you know, even if the strategy works really well, we might still lose because of outside forces. So never overcommit to the pool. But having, say, $5,000 across all pools, I think does make sense. You should be able to at least get your money back. At least if history is any indication. Kobesi Letter reports retail investors buying the tech stock dip in masses. Do you think there's opportunity now for things like MSFT, Amazon, Meta? So yeah, so let's talk about stocks for a second. Microsoft, Amazon, Meta. In general, right? I'm not really a fan of getting into stocks heavily right now, besides just for diversification purposes. This year is the stock market's valuation relative to the price to earnings ratio. It's now at very similar levels to the .com bubble. And yeah, we know what can happen afterwards, right? When the .com bubble deflates, prices go down. Subsequently, we had the global financial crisis. So even the .com deflation wasn't enough for the market. What we've got over here, that's the depression, right? The depression of the 1930s that subsequently led to so much pressure in various world economies that it led to World War II. It's hard to say whether or not from peak to peak we actually see rising PE ratios. There are some arguments for potentially long-term rising PE ratios, that maybe stocks should, over the long term, appreciate versus their earnings. Because now more and more investments are being done in stocks. There's basically adoption of the stock market. Everybody invests in 401ks, etc. So there is that. There's also more and more support by the government for the stock market. There's artificial propping up of the stock market through monetary debasement whenever we crash. So the US dollar is less safe. So that's maybe why there's a flight towards the stocks. So there is a reason to believe why we could potentially be at a higher peak. That being said, still just looking at this long-term chart, right? Looking at a chart that starts in 1987, we're definitely not cheap in the stock market. So that's a potential problem with buying dips for the long term in tech. There's another problem. Have a look at the NASDAQ relative to the S&P 500. So this is now a chart of how expensive are tech stocks relative to stocks in general, right? So within the stock market, how expensive are tech stocks. What we see here, right, with this square, that's the dot-com bubble. So we had a quick acceleration of tech stocks. Tech stocks outperformed the rest of the stock market by more than 200%, and that got corrected very, very quickly. But then we also see how very long-term tech stocks tend to underperform other stocks. And we also see that even if there was an AI bubble right now, how the AI bubble did not accelerate tech stocks much more compared to regular stocks. So we don't see this quick spike. The valuations are high, but the momentum isn't that extreme. That would tell us, okay, we will see a burst very, very quickly. If things are coming down, if the stock market was to sell off, it's probably going to be the entire stock market. It's not going to be just a dot-com crash. It might be labeled the AI crash, but I don't think that it will be just the tech stocks that will come down. Probably everything will come down because PE ratios are simply so high. Tech stocks, relative to regular stocks, they are expensive, but they did not necessarily appreciate as quickly as they did during the hype phases at the end of the 1990s. Now, what about specific stocks, right? So what about Microsoft, Amazon, and Meta? What I like to look at is always relative valuations. So we can simply enter those stocks in TradingView. So MSFT relative to the NASDAQ. And then we just check whether or not the idiosyncratic risk that we currently have with something like Microsoft is worth it. And when we just see this, right? When we see this chart, really, we didn't have any outperformance of Microsoft versus the rest of the tech market in the last 30 years. And we did see a dip that was above average, but it hasn't dipped as much compared to, say, the Steve Ballmer times. So we are not at a historical bottom, right? A bottom like this one over here. So things could potentially get worse, right? Microsoft could potentially fall another 40%. So I'm not really convinced to buy this just yet. Just regarding how much outperformance we might get. I think Microsoft just performs according to any other regular tech stock right now. And I think it's best to only buy it when it's really clearly cheap. Because the outperformance isn't long term, and because it's not clearly cheap right now, I wouldn't necessarily get into Microsoft for the long term. Let's look into Amazon. So that's Amazon relative to the NASDAQ 100. That's this chart. Here that tends to be a bit more outperformance, but still over the last 10 years, it's not really that obvious, right? So Amazon isn't necessarily doing that well. So again, it's not necessarily something I'm super interested in buying idiosyncratically. You can simply just buy QQQ and you'll get the similar kind of performance without the idiosyncratic risk of a single stock. Let's have a look at Meta. Here's Meta relative to the NASDAQ 100. It's on a downward trend, but it has crashed before much more. There are different reasons for those crashes though, right? So this year was the question whether or not Facebook will also get enough adoption on mobile phones. At the time, the mobile phone adoption was really, really poor. And so Facebook crashed. Then they were able to improve their app, were able to not just build this on a React-based app, but had their own applications for individual platforms that then improved loading times, improved adoption for the mobile platform that helped. The subsequent crash was the malinvestment in VR, right? So overinvestment into virtual reality that didn't get the adoption. That got then dialed back down. Now the VR investments are way more let's say they're way more realistic relative to revenues. They're still ongoing. There's still new Quest developments, but they're not as aggressive as they used to. And because of that cost cutting, Meta was able to bounce. And yeah, let's see what happens here, right? Maybe if the AI bubble was to suddenly crash, we could see another dip, and that would put it down to roughly by 60% versus the NASDAQ 100. So yeah, I'm not necessarily a fan of getting overexposure to any stocks right now, and especially also to most individual tech stocks. So hope that helps. Thanks a lot for the detailed brief on gold. Yeah, welcome. Bottom is zero. Yeah, for everything the bottom is zero. If the dollar goes to zero, then there is no bottom. Then everything goes to infinity. By the way, it's very impressive how bad the dollar is currently doing. I haven't looked at the DXY for a while, but I expect it to be down. Yeah. I live in Malaysia, and my income here is in US dollars, right? My YouTube income and my premium income, and I have expenses in Malaysian ringgit and in euros, and it's getting more expensive by the month. Let's have a very long-term look at the DXY. just for the fun of it. Check the equilibrium. Yeah, it's interesting. We are now very close to an equilibrium, right? So this was the DXY historically. So how strong is the US dollar relative to other fiat currencies? It's weakening more than the rest of the fiat world. The fiat world itself is relatively weak already, but the US dollar is even weaker. Silver top already in? Yes, I believe so. Let's talk about silver in more detail maybe in the next live stream. I think this time we've already talked quite a bit about gold. Given the growing anticipation of tokenization of much of our world's assets, what are your holdings in order to capitalize on that prospect? Thank you. I think this question is interesting because there is this push by BlackRock whether or not we will see more and more tokenization of real world assets, and we will see more capital flowing into those assets because they become more accessible for the average investor. But I'm not actually that convinced that that's what's going to happen, because in the end, what it means when we tokenize an asset and we allow everybody to trade that asset, we completely bypass all laws regarding capital controls. We bypass all AML laws, right? Anti-money laundering laws. We bypass pretty much everything. And so while this can attract, of course, capital, because now people can invest into something that were not able to invest beforehand, it also brings potential instability into a market. And so that's why probably there was quite a bit of a pushback in the early days when Binance first started to offer tokenized stocks. Because just a few years ago, right, when Gary Gensler was still head of the SEC, he sued Binance for offering that. He sued Binance to tokenize stocks. Now that Trump is in office and he's got a more pro-crypto stance, of course, Binance relaunches that again. But that's a fundamental issue. Whenever we tokenize something, we take away all of the capital regulations that we had before that allowed people or did not allow people to invest in something. Insider trading becomes super easy when we tokenize something. And insider trading is just extraction from a market by a few people that have an unfair disadvantage. And that's, of course, a problem for the general masses, right? If the market itself is rigged, if the market is too much in favor of the few people that know a few specific points of information, and they extract that much value out of that market, that's at the expense of the general public. And so the general public will have less and less returns. And of course, a few people will have more and more returns. But of course, if that becomes too strong of an effect and the masses don't even generate enough returns to, say, offset monetary debasement, then it becomes less and less attractive to invest in the stock market. And that is a real effect. We see this, for example, in China. In China, we have a somewhat rigged market, right? The stock market isn't as developed, auditing isn't as developed, insider trading is relatively rampant. And so when we look at the stock market performance over the very long term, it's really not that great. And that's why everybody then invests into property. And so there was just overinvestment into property, and that's why in the end we got the property crash in China. There was just this only asset class in China that you could invest in that seemed to not have been that rigged, right? There wasn't that much insider trading, but that's the problem, right? The US does not want the US stock market to become unattractive. And so that's why I have my doubts that the tokenization of assets will become a super quick, super well spread thing. There might be some advances every now, here and then, but it won't be a really broad thing. At some point, the regulators will put some stop towards too much tokenization. And especially when it comes to the tokenization of individual stocks, I do think at some point this will turn around again. Simply because long term, it's very bad for the health of the capital market in the US. But yeah, so I am not trying to capitalize on that trend. I do think that this trend will turn around and that BlackRock is not correct on that trend picking up. Let's go through a few more models, right? We've talked about the realized price as a potential bottom for the bear market, 55K. We've talked about the long-term holder realized price, that's at 40K. Historically, we tended to even fall below that long-term holder realized price. We already talked about the balance price and the CVDD. All of those metrics give us somewhere values between 50 to 40K. And when we look historically at Bitcoin, and when we check how much did it actually fall during bear markets, then our current decline is not yet enough, right? So this is the Mt. Gox Silk Road collapse. We went down by 85%. This here is the ICO bubble crash. We went down by 83%. Then we had Terra Luna, Three Arrows Capital, FTX. We went down by 76%. So yes, with every bear market, we tend to decline less compared to the bear market before. But the current bear market has only seen us a 50% decline. I'd expect at least 60, maybe 65% of a decline. And interestingly enough, the pace at which we decline tends to be quite comparable. So have a look at this year. So that's now the ICO crash. We crashed at a quite similar pace in 2022 as well. And if you overlay this to our current price decline, also, right? We are a bit behind schedule here, but still, it seems like the declines are comparable. Let's compare this with FTX and Terra Luna, etc. That bear market. So again, we take the measure of how fast we declined, how much we declined. We overlay this to our current crash, and pretty much just according to plan, right? If we are in a bear market, and it's very likely given that we've already dropped by 50%, we should expect more of a decline. Probably not all the way down to 30K, right? That would be the decline if we just repeat the same kind of bear market that we've already seen in 2022. We might turn around a bit earlier, but seeing the 50K, seeing the 40K, I think is very realistic. If we go down to 40K, we'd be still at a decline of less than 70%. And in 2022, we lost by 76%. So 60 something percent, 65, 68%, I think is the minimum we go down in a bear market. And I do think this is a bear market, and I do think 40K is a very realistic price target for this bear market. So it very much depends, right? Should we buy this bottom? Should we not buy it? It really depends on your time horizon. If your time horizon is several months, I do not think this is the right time to buy. If your time horizon is just a few days, maybe weeks, then of course we could potentially rally a bit further. We've talked about this with our moving averages, right? I try to time the market using the best moving averages. This is the 44-day simple moving average. I'm talking about this in pretty much every video, so I'm not going to talk about this in more detail in this stream, but we could easily go back to say 80K and we'd still be below the 44-day simple moving average. We'd still be bearish. So if you're currently buying this dip just in order to bet on a short-term recovery and then you're selling again at 75 or at 80K, I can totally understand that. I personally do not buy against the general macro. If I think the general macro is bearish, I'm not really a fan of buying any dips. I just want to have the time on our side, right? If currently the market looks rather bearish, then I think it's better to just be cautious and to just bet on falling prices. So what I tend to do in general is, if we are in a bull market, I buy the dips. If we are in a bear market, I short the tops. And so if currently we are in a bear market, if that's our fundamental thesis, then we should rather look for opportunities to short the tops, not necessarily to go against the general macro. Right, so that would be as if you were to try to short the tops in a bull market. If you buy the dips in a bear market, that's the same as shorting the tops in a bull market, but time is then against us. If the general macro is really not that bullish, then why should we try to buy bottoms like this? I think it's better to just be rather cautious and look for potential new short opportunity in case we do rally to our 75 or 80K. That's fundamentally how I go about this market phase, right? I rather try to time the bottom in case we go below our very low valuation metrics. In case we go to 40K or so, I try to time the bottom. But outside of that, I just continue to get on the general trend. I really appreciate the deep dive, man. Thanks. Thank you for the nice comment, Rockdark 440. Do you hold Ondo? No, I do not. I do not hold any altcoins right now. Bro, really? Bottom? Yeah, I said, right? It depends on your time horizon. Very short term, potentially over the next months. I do not think so. Show us your last trade, please. Yes, here's the last trade. This is shorting Bitcoin on our moving average vault. That's currently up 600K. So we started this vault in October of last year. We are up roughly 10%, a bit more than that, while Bitcoin during the same time period lost 43%. So imagine in Bitcoin, we have roughly doubled our capital over the last 4 to 5 months. So yeah, that's the power of following the trend, right? Not just buying and holding, but actually taking advantage of what's happening very long term. It's actually more than what we anticipate. So our backtested result is this one over here. That's for the 125-day, and this for the 44-day. This is a logarithmic scale, right? So buying and holding Bitcoin, that's this chart over here. Here's the backtested result. According to the backtest, we make a bit over 100% alpha per annum over buying and holding Bitcoin. Now we got the 100% already over the span of a few months. So obviously this outperformance is not representative. Usually it takes a year, not just a few months. But yeah, we've been doing quite well during this crash, while most people unfortunately did not. Solana's up 9%. Let's have a look at Solana, just Solana dominance. Yeah, it's up, but I'm not yet convinced. So this is where I see Solana's dominance going. We talked about Solana in a prior video published a few days ago. We've been in a trading range for a while, but if we really do enter a bear market, the problem is that Solana is very much correlated with the general market. So if we are in a bear market, right, so let's say we just look at Bitcoin in US dollars, not Bitcoin as a dominance. And we look at Bitcoin in US dollars, let's make this in orange on a logarithmic scale. When Bitcoin is in a bear market, when Bitcoin sells off, then Solana tends to sell off even more. So Solana, in a way, is a levered bet on crypto as a whole. If Bitcoin goes down, Solana goes downer. When Bitcoin goes up, Solana goes upper. And so now if you expect Bitcoin to go down, then Solana's trading range can probably not prevail. It's probably going to go down further. Today, it might be going up, but the overall long term, I think, is not that bullish. Render update. As said, I'm out of altcoins right now. It might make sense to short some altcoins, right? We are shorting altcoins, but buying any altcoins, I think, is a bad idea. I'm surprised. The Trump token, the S&P 500, and crypto had 0 reactions on the Epstein files. In Europe, some people stepped down from major political positions because of the files. Seems like not much in the US. Yeah, so we can see who actually has power, right? Who actually runs the world. It's less democratic in the US than it seems to be, right? There's more power of capital than people want to see. What are you investing in when everything is expensive or has topped? Yeah, this is a good question. What I'm going to buy when everything has topped, when everything is expensive? Precious metals are expensive, stocks are expensive, and crypto starts to become cheaper, right? Once Bitcoin is at 50 to 40K, I'm definitely going to buy it, even against the general momentum, right? Even if we are below the moving averages in Bitcoin, I'm still going to buy the bottom for dollar cost average purchases for the very long term. If everything else is up, right? So if still the stock market is up, if still property is up, if still precious metals are up, and only crypto has crashed and crypto is close to the average cost basis, then I do believe it makes sense to buy. What am I currently doing? I am heavily in cash. So that means just fixed deposits, just getting my 4 or 5% per annum. That offsets the majority of the monetary debasement. Not all of it, right? We have 6.8% monetary debasement, but it offsets the majority of it. So I do not have to be invested that much if interest rates are relatively high. So that's a major position. And then for everything where I'm idiosyncratically exposed, I simply short the market. So I'm shorting the market in Bitcoin, but I'm also looking for shorts in traditional finance. Now I try to not do too many bets on traditional finance because it's much more competitive, right? If we try to time the market in various technology stocks, it's very hard because the banks have full-time analysts that look at balance sheets all the time, that look at technical developments, that have insider knowledge potentially as well, that have their dinners with the CEOs, etc. So it's very hard to beat traditional finance, especially on the large caps. But still, right, if I try to look for a simple exposure, if I try to look at single assets that I want to be invested in, I'm just looking for short opportunities. I am looking at shorts, for example, of Tesla. I think that Tesla currently is overvalued. The fundamental business of Tesla is struggling massively. There's all of this competition by China. BYD, for example, builds a very good cars. We've got both here in Malaysia. We've got people that drive Teslas. We've got people that drive BYDs. And to be honest, I do think that the BYD cars are better. They look much nicer inside. They are cheaper. Who knows what happens long-term to those cars, but long-term, right, the build quality of Tesla isn't that great either. So Tesla is under massive pressure on the vehicle front, and so it tries to just sell the next dream. It tries to sell the self-driving cars. That has not materialized over the last, who knows how many years, right? Self-driving cars where just 1 year from now, for many, many years, it seems very similar to energy production, right? Where we had fusion just 10 years from now, and that's for the last like 50, 60 years. So it seems to never really happen because it's very hard to solve those edge cases. That's a problem. Another problem, of course, is that Tesla now tries to sell this humanoid robot game. But how much will the humanoid robot game actually play out? We have heard how it's very hard to build those hands, to have very precise hand operations. We don't see them used in factories either. There was a competitor, I forgot the name, but there's a competitor of humanoid robots that was able to deploy some robots in a factory, a BMW factory in the US. But that was also just a test project that was not rolled out on a larger scale. So that's also not economical. So when we do not see yet a business model from Tesla that's already making money to a degree, that had at least some kind of a medium-term perspective to generate positive cash flows, to generate profit, I don't think that Tesla is worth it. It's of course hard to bet on the guy that's launching rockets into space and it has built Tesla in the end. But I think Tesla is simply now just in a very complicated spot. And so that's a potential short. But of course, that short shouldn't be too big, because still it's traditional finance, still it's very hard to beat, and still it's betting against one of the richest men in the planet, and maybe there might be some financial trickery and some merging with SpaceX that could rally the price again. There's all kinds of potential risks here, but in general, I think Tesla might be a potential good short. So that's what I'm trying to find, right? I'm trying to find opportunities where I'm rather delta negative to delta neutral, and if then at some point one asset class becomes cheap enough, then I am buying that asset class. And it looks like that might be crypto in the near future. It's not. Right now, the best asset class is still relatively expensive, but the momentum is on our side. We are coming down, and once we are low enough, I think it does make sense to buy Bitcoin. Start to buy Bitcoin at 50 to then afterwards potentially 40K. That's my buying range. And I've been talking about this range actually for quite a while on this channel as well. So yeah, hey Gerhard, you have my crypto YouTube at You Are Wizard Justin. Muted by mistake. I'm premium. Oh, sorry. Yeah, I will have a look at this. This might have been automatic blocking through my spam bot. If you have been commenting, say, on another spam bot at some point, and you say, hey, please remove all the comments with word ABC, and then my tool removed everything with ABC, then it also automatically blocks all the accounts that mentioned ABC, and maybe yours was included in that. I put this in my to-do list. I will start to have a look at this and unblock you. If we drop to 40K and then the stock market crashes, is this possible? Yes, it's possible, and I do think that it will have a bad impact on crypto as well. Right, just have a look at Bitcoin's price here at the bottom. Let's take the Nasdaq 100 at the top. There's obviously some kind of correlation, right? They tend to bottom at the same time. This year was COVID. They tend to top at the same time. Here again is a bottom. Now this time crypto is selling off a bit faster than the stock market does. But in general, the two assets tend to move in the same direction at the same time. That means if crypto, or let's say Bitcoin reaches the 40K and subsequently the stock market was to crash, then of course Bitcoin could go even much further. So that's a potential risk that we take, right? Nothing is free of risk, even if we buy Bitcoin below those levels that historically worked well, right? The realized price, the long-term holder realized price, all of those models, they break down in case the Shiller PE ratio suddenly goes down to 20, because we really don't know what happens to crypto when the overall market crashes like this. Bitcoin has been created here, right, at the beginning of 2009, and it started to get real price discovery in 2010 with Mt. Gox. So that's the fundamental issue, right? We've never really seen a contraction of risk on assets, and unfortunately, risk on assets are correlated with crypto. When the Nasdaq 100 crashes, then Bitcoin crashes as well. So there is no guarantee that we will see the bottoming of a bear market at those levels. I simply think it's a good risk to reward once we buy between 50 and 40K. Because if the AI bubble was not to pop, and that's very much possible, right? The AI bubble might never pop because it's not propped up that much by retail investors. It's propped up mainly by technology companies, and technology companies accumulated a lot of cash during the last years, and they deployed all of that cash into AI. So if that just continues running and the AI valuations stay where they are, and the technology companies do have a strong interest in that not coming down, then we might never really see that crash. We might simply just see those elevated valuations for a long, long time, not appreciating. And if we wait, say, for 5 to 10 years at the same kind of valuations, and then the monetary base goes down by 6.8% per annum, right? So if the US dollar devalues by close to 7% every year, and we just stay at the same US dollar valuation for 5 to 10 years for AI companies, then the valuations are suddenly healthier again. So it's all just a matter of how much upside is there versus how much downside is there. I do not think there's a lot of upside for technology stocks or for AI related investments because the prices are already that high. But that doesn't necessarily mean that the prices have to come crashing down. The prices can just stay at that current level for a long, long time, and then the US dollar might debase over the next years, and then valuations become realistic again. So that's actually my base case. I think that's the most likely scenario. If we don't suddenly start to rally much further, I think that's the most likely thing to happen. Because let's have a look also at the following. I found this actually quite interesting. When you look at the DXY and you look at its performance over the last year, right, the DXY lost roughly 11%. Okay, or if we were to go up from here, it would appreciate by roughly 13%. So that's how much the dollar has weakened. Now, have a look at the S&P 500 over the last year. How much did that go up? So let's take February and take the next 12 months. It appreciated by 13%. So the S&P 500 appreciated to the same degree that the US dollar versus other fiat currencies even has devalued. So if we were to measure the S&P 500 in euros, for example, it would be completely flat. And of course, the euro itself is also devaluing over time. So if we measure the S&P 500 relative to gold, then of course it's down. And so this is how we can actually get a clearer picture of what's actually going on. What I think is most likely going to happen is that tech stocks are very likely just going to stay where they are. Maybe they go down slightly year over year by a few percent. We're probably not going to see a massive crash. Then as they go down slightly, maybe 5 or 10% per year, and the US dollar devalues by 7% per year, right, just through the money printing, then just over 5 to 10 years, we will have okayish valuations again. And that's how I think things are playing out. And that's why I think it does make sense to buy the bottoms in crypto once valuations are cheap enough. Last year, you had a parallel white curve drawn in your Bitcoin chart, which I remember correctly marked the top. Could you show us this, please, again? If you have it for the bottom. So I think it's the chart for BLX. The issue with that chart is, so this is actually not parallel. Those are just two curved lines that, interestingly enough, connected the tops and the bottoms relatively well. The issue with BLX is it doesn't update anymore. So for whatever reason, this index has stopped updating in August of last year. Yeah, the tops align pretty well. We did anticipate the sell-off in October of last year. By the way, what I recommend you to do, in case you've never done this, have a look at other crypto YouTubers, the crypto YouTubers you currently follow, and check what did they actually say in October of last year. Were they bullish or were they bearish? And then have a look at the same kind of content over here on this channel, of course, and then compare, and then check whether or not you want to follow a certain influencer still. Have the same look also for other, I think it's always the turnaround points that are interesting, right? So let's say the bear market bottom, where your favorite influencers, bullish or bearish at the time. So just check out the videos at the time of various people and see whether it makes sense to follow. But yeah, this is, I think, an interesting chart. We can draw something similar for Bitcoin. I'm not sure if we have. See if I've got a curved line here. No, I do not. But we can, of course, just do this together right now. So we have our curved line. The problem, unfortunately, with the Bitcoin chart, even though it's more recent, right, it's still updating. The problem with the chart is I don't have as much of the very early data. So this data only starts at the at Q3 2011. But still, it's probably good enough. Let's figure out where those bottoms align relatively well. Let's include the COVID crash. Let's include the early data. It's it's almost a miracle, right? How those, with just a curved line, how those bottoms and how those tops align pretty well. So I think this is pretty good. All right, so we have almost everything in here. I think this is best. Now we've got COVID in here. We've got everything quite nicely aligned. If we just take that potential bottom, then if we were to crash tomorrow, we'd fall to $52,000. So that would be the potential bear market bottom according to this chart here. Now, this might not be perfect, right? Because we have seen adjustments to similar approaches in the past. There is the Bitcoin rainbow chart that got adjusted every now and then. There are all kinds of logarithmic regressions that have changed. So here, let me show you what I mean. This here is the Bitcoin rainbow price chart. In the early days, we didn't have this purple area over here that was just added after the bear market was more severe than people anticipated. Also, we see how this particular chart overestimates the cycle top in 2021. So many people were actually waiting for at least 100K in Bitcoin and were not able to sell the top at 70K. So approaches like this, they are nice entertainment. They can work to a degree, but I would not be surprised at all if you actually were to fall below the 52K. There are other approaches like the 200-week, the 200-day moving average, right? So, or the 50-week moving average. If we take the 50-week SMA, so let's just add a moving average, simple moving average. We are now on a weekly chart. We add 4 years, I believe it was mainly. The 200-week moving average. That's the one that we want to look at. The 4-year moving average, basically. Historically, it used to be a very nice bottom indicator. So just have a look at this, right? We bottomed out after the ICO crash over here. We also bottomed out quite nicely, just shortly fell below it during COVID. And then came the big surprise after FTX and Terra Luna. Suddenly, what used to be a really, really nice bottom indicator stopped being a good bottom indicator. And we went below that for several months by quite a bit, right? So by 33%. So models that used to work don't necessarily have to work in the future. And in the early days, people said that Bitcoin is very unlikely going to fall below the 4-year moving average. And the reasoning behind this was that Bitcoin halves every 4 years, right? So the newly issued supply of Bitcoin gets cut in half every 4 years. And because of that, there's the 4-year cycle. And because of that, we get a rally every 4 years. And because of that, we should also stay above the 4-year moving average all the time. That was the reasoning why we should always be above that moving average. And that's why many people at the time here thought that we'd bounce very quickly from the 22K. But we didn't bounce at the 22K. We went down all the way to 16K. And so this is then the big question, right? If you rely too much on a single model, then you might not continue to buy at those levels, and you might give up, and you might think that whatever worked in the past, it doesn't work in the future anymore. And so then you're missing out on the very best bull market that subsequently followed, right? If you continued buying, you had the chance of making, just in Bitcoin, more than a 7x. So that's why we have to be a bit cautious, and that's why just drawing a line like this might not necessarily give us the absolute bear market bottom. By the way, this 200-week moving average is currently at $58,000, and we bounced off that with the crash recently. Thank you for the question, Patrick. I think this is a very, very good question worth discussing. I like your 10 or so recent mindset videos that explain things that people need to start understanding, especially like passive income is BS. Explaining capital concentration. Yes. I like to think about things in a more fundamental manner, right? When people always say houses are going up forever, I'm wondering why, right? Why are they going up? Why are houses a good investment? I want to have a new house, not a house that has been built 100 years ago. So why should the house that's 100 years old go up over time? And so then you start figuring out those things with monetary debasement. Then suddenly it makes sense why gold over the decades goes up. It makes sense why the S&P 500 over the decades goes up. And then it makes sense to make all of those relative valuation assessments, right? Figuring out how something is performing relative to the monetary base, and how then capital is just moving from one place to the next. And since over time, right, the rich become richer, the poor just stay where they are, the gap widens over time. Because of that, we've got all of this additional capital that's concentrating and not operational income that's growing at the same pace. We have more and more capital chasing the same amount of operational income. And so that's why returns on capital go down over time. And that's why passive income in the end is less and less of a thing. It's more and more fluctuating over time. It's becoming smaller and smaller, and it's just moving from one asset to the next. So really what we have to do is we have to figure out what asset class should we invest in. We should still have a diversified portfolio. We should still protect ourselves against monetary debasement, but we should not just have a static diversified portfolio. We should over allocate towards the asset class that's currently cheap and under allocate towards the asset class that's currently expensive. And what's currently cheap, what's currently expensive, that's the art or the science or the combination thereof. And that's in the end where actually the money is being made. So capital really is just a lever on market timing. We can't just set and forget anymore. And this, I think, a thought that most people don't have. But yeah, I try to figure out those things. I try to figure out where can I have original thoughts that others don't have that might bring us an edge in investing, and then I just discuss those things in those direct one-on-one mindset strategy talks. I also like those videos for me personally because sometimes I'm on vacation and I just like to have a stack of videos that I can publish anytime, and those kind of fundamental thoughts, they can be recorded like 1 or 2 months ago and then can be published whenever I'm on vacation. So it's also from a YouTube perspective a quite nice thing to do. But yeah, thanks. I'm very appreciative that this kind of content is helpful, and I will continue making that content, even though it's not necessarily growing the audience base much. It doesn't get a lot of new subscribers. People don't search for those kind of things, but I think especially the existing people that watch here, that are also watching here this live stream, I appreciate it, and so I continue doing it, right? I like to help wherever I can. Do you think ETH will bottom first? Very hard to say. Usually Bitcoin appreciates first after the bear market bottom is in. So Bitcoin dominance continues to rally. Ethereum is then just another risk on asset that rallies after that. I asked Rock just now about real-world asset tokenization. I believe the tokenization of real-world assets representing things like treasuries, real estate, credit. yeah, there are some real world assets that can be tokenized well. We actually already have this, right? We've got the US dollar. That's more or less a real world asset that's getting tokenized through stablecoins. For real estate, it's a bit more complicated. Private credit, we do have through Ondo, but that's also just a bubble waiting to pop, because whenever private credit gets tokenized, the quality of that credit is really the main culprit. And that's actually the main basis how banks operate, right? The bank's major risk is always credit defaulting. They make money on expanding credit. They create new money out of thin air. But if that new money suddenly doesn't get the cash flows, doesn't get the operating cash flows, then the debt defaults and then the bank goes kaput. And so that's a problem with tokenizing private credit, because then suddenly we now move that risk that the bank has to assess. We now move that risk to the buyer of the tokenized debt. And so then this incentivizes whoever issues the private debt, the tokenized debt, to just issue as much as possible, make fees in the process, and then the bag holder is the one that's buying the private debt once the private debt defaults. If the bag holder of defaulting debt is the bank, then the bank will be careful of issuing the debt. But if the bag holder of defaulting debt is somebody else that bought tokenized debt or that bought mortgage-backed securities, if the bag holder, the risk taker of the debt, is somebody else that's not really helping to issue the debt, then the risk really starts. That's really where we want to be careful. We do not want to necessarily buy private debt where the risk assessment has been done by somebody that gets incentivized to buy to issue that debt. We want to just underwrite debt where we already made our own risk assessment. So that's why tokenized debt might become a thing, because some people get a lot of money doing it, but it might be very, very problematic to buy into that debt. I think it's the same as buying mortgage-backed securities. It's just a ticking time bomb. But it might be something that could grow, because the incentives are misaligned in a way that the issuer can make a lot of money and the buyer might not be aware of what they're getting into. But yeah, there is some tokenization of real-world assets. We've got the US dollar. We might get more of private debt. But especially when it comes to regulation, right, when it comes to securities, etc., tokenizing those just circumvents insider trading. And this might be less of a problem, say, with ETFs, right? So tokenizing, say, the Nasdaq 100 is okay, probably, because here insider knowledge doesn't help us much. Tokenizing very large tech stocks might also be somewhat okay, because there is less of an insider edge, because a lot of the relevant information already leaks beforehand. But especially for the smaller stocks, that aren't as efficiently priced, where insider knowledge gives us a lot of edge. When those get tokenized, that's pretty much the death of the market of those stocks, because then medium-sized stocks will have a very hard time on average to outperform. So that's why I don't believe in real-world asset tokenization for smaller stocks, especially. For the major stocks, it might come. Smash the like for 650K profitable trade, guys. Yes, please. Feel free to smash the like button. It will help spread this stream to more people. We currently have 115 people watching. Thank you very much for watching. Feel free to also comment, of course, because comments also help the algorithm. I see like the number of interactions after every stream. So if you just say hello, that already helps. If you press like, that helps as well. And that will help to spread this a bit further, right? That's always very much appreciated. Hit the like if you like trades that make overall $500,000, guys. Yes. Thank you very much, Harry S.O. Sassy. Harry So Sassy. Energy and resources. Agriculture, oil, coffee, soybeans, wheat are cheap. They are in their trend reversal zones. Yeah, there is a bit of a problem with those commodities, and that's the financing. So I haven't looked at this for a while, actually, but roughly 10 to 15 years ago, all the instruments that we had for agricultural commodities were extremely expensive. The same as, for example, if you want to bet on volatility, right? If you want to bet on the volatility index going up, those kind of ETFs have very high costs. And then the question is always, is our expected value of appreciation, right? Do we expect the probability of appreciation and the degree to which it will appreciate high enough to offset the cost? So I have to look at into this in a bit more detail. Maybe if you have a few ticker symbols, feel free to comment them down below, of various agricultural commodities where the fees are not 4 or 5% per annum, but where they're actually reasonable. And if that's the case, if you can actually now trade oil and wheat and pork bellies, etc., and say chocolate, right, or coffee, if you can now trade those relatively inexpensively, then I might consider actually getting into those assets. But if we have a ticking time bomb, right? If the time is ticking against us, if the funding rates are very, very high, I'm still very cautious betting on those markets. But in general, right, it might be an opportunity. I haven't looked into the prices in detail, again, because I haven't found proper instruments to bet on those prices. But if you do, feel free to comment ticker symbols, and I'll put them in a file afterwards, and then I will have a look at them and check if the funding makes sense, if the financing costs of those instruments actually are good enough to potentially worth entering that market. But yeah, my edge right now at least isn't strong enough to offset very high funding costs. BYD doesn't have a CEO who has a contract to pump the income to exit with a specific bonus. Yeah, but I still like to bet on fundamentals of something, not necessarily on those small little details. What do you think? Is Bitcoin leading the S&P 500? Potentially, right? We know that prices are very expensive right now. Bitcoin did not lead during the COVID crash though. During COVID, stocks sold off first and then Bitcoin sold off a week after that, interestingly enough. The spillover effect was quite slow. If you were in altcoins, would you sell to buy lower or hold from here? I would short them. Short the altcoins and bet on rising prices of Bitcoin, relatively speaking, especially the highly inflating altcoins. That's what we are doing. Why buy the 40 to 50K? Isn't better to wait for a close above the 125-day SMA or at least 44-day SMA? That's actually a good question. So should we, when we've got two models, right? We've got our moving average trend following strategy and we've got our valuation strategy of realized prices, etc. Where we've got two contradicting models. We've got the negative momentum, but we've got cheap prices. What should we actually do? Of course, the ideal scenario is that both approaches result the same, right? We are very low in our valuations and we are still above the two moving averages. Unfortunately, this doesn't happen very often. Once it does, though, it does make sense to become very, very much risk on. So what I tend to do is I've got my trend following strategy. So I simply just bet on the moving average irrespective of valuations. And then I've got my part of the portfolio where I dollar cost average into Bitcoin. And that's native Bitcoin. That's not derivatives. That's not centralized exchanges. That's just native plain Bitcoin. And so what I do is basically I then have two opposing positions. I've got one position where I just bought Bitcoin and I forget about this. I've got another position where I'm shorting Bitcoin, where I'm betting on the current trend. So I will be more or less neutral during those times. Now, if we fall even further and further and things become cheaper and cheaper, I will dollar cost average in more and more with the native Bitcoin. And then I might be net delta positive. So then I might actually get more exposure. And when Bitcoin goes up, I make money. If we just start to be below the cheap price, and I do think that there is still room to fall further, right? So let's say we are at 50K, and I think there's a good chance we go to 40, potentially even 30K. Then if we just started to enter the 50K mark, I'm probably still delta net negative because of the trend following. And then as we go lower and lower and lower, I dollar cost average in more and more and more until I am delta positive. And so then I'm already delta positive because we're that cheap. Then we might bottom out, hopefully at some point, and we go above the moving averages, and then I go really risk on, right? Then I'm really delta positive. I'm so delta positive from the dollar cost averaging. Now, in addition, I flip the position of the trend following, and then I'm really, really long. And that's the ideal scenario. And this works really, really well. This has worked pretty well for me in the past. Just have a look. I use the realized price. Just have a look at 2022. So we would start to buy in once we fall below the 20K. We would be buying in more and more and more as we fall further and further with our dollar cost averaging. But when do we actually flip? We flip once we are above the moving average. So let's go with Bitcoin again. Let's add the moving average lines. I used the 125-day at the time, or rather 120 because I've updated the back test. But yeah, I would start to buy in at around, what did we say, 20K, right? So that was here. In this area, I would start buying every now and then, even if we are below the moving average. I would buy even further in as we are still below the moving average, but we are below the realized price. So I want to have long-term exposure with native Bitcoin. And then once we hit above the 125-day moving average, or at that time, the 120, very similar though, then we go really risk on. And that's still early enough to get plenty of upside, right? So if we are below the realized price, usually we have dropped by at least 60, 70%, and then we have a multiple X return from that. And then we are fully in the market. So that's the ideal scenario. We want to ideally be below the realized price, below those cost bases, and at the same time above the momentum indicators, above the moving averages. That's the ideal scenario. This is where we should go most risk on. If we don't have both indicators flashing green, then of course we have to be a bit more balanced in our assessment. I quickly want to talk about the potential tops. So there are different approaches to measure, right? Because in the end, what we are looking at is always risk versus return. We already assessed the risk. If AI stocks are not going to crash suddenly, probably the worst case for Bitcoin is 30K. But we might already bottom out at 40K, and it might make sense to start buying in at 50K. That's at least how I personally navigate this market. The question then is always, how much could we go up from here? So what's the potential risk? Let's say we buy at 50K. What's the potential reward that we get versus that risk, right? When we buy at 50K and we could still go down to 30K, and nobody's perfect, right? We don't even know if 30K will be the bottom, right? Anything could happen. But let's say we buy at 50K, we say our risk is to fall down to 30K. What is then our potential upside? What's the reward? What's the risk versus the potential reward? And that's why I like to look at the top indicators as well, even if we are currently in a bear market. There is the top cap indicator. It monotonically increases. It looks at value days destroyed. It looks at how many transactions are being made. That's currently at 647K. That's a potential top. The problem is with this indicator, it did not hit in 2021. It overestimated the top by 2x roughly. So we should at least cut this prediction in half and give this a, say, 320K top at maximum, right? So probably below that. There's another indicator which I think is a bit better. It's the delta top. The problem with this indicator is that it's not monotonically increasing. So every now and then it goes down, and that's not necessarily great. Here, our potential reward is 250K. So that's interesting, right? So we buy at 50K, we might get a 5x back. In the best case. That's the delta top. Here's the terminal price, and this is the indicator I like the most. Why do I like it the most? Because during the peak in 2021, the delta top did not hit, but the terminal price did. And the terminal price is also monotonically increasing. The problem a little bit is that in prior bull markets, we tended to overshoot that terminal price, and we tend to overshoot it less and less as we went on. And so there is a chance we're actually not going to hit the terminal price this time, because we overshot more over here in 2017 than we did in 2021. And so since the overshooting, the degree of overshooting is declining with every bull market, we might not even be able to hit the terminal price this time around. What does that then mean? It means that maybe we are not going to hit that level. And so let's refresh the page. Let's look at the current terminal price as it stands. And there we go. This website is rather slow. But in general, right? In general, I like to look at price predictions that way. I like to always see what's potentially the worst case. How do I realistically look at something? So I don't just take a model as it is and then say, okay, this is our level. I try to figure out how well did it work in the past and how were the deviations from that model developing over time. So if something overshot quite a lot in the early days and then overshoots less and less over time, I think that the model is potentially overrepresenting the growth. So then it probably will underrepresent how much we could over or undershoot. So here in this case, we've got a terminal price of 300K. That would be my absolute tip-top optimal scenario. So 300K, probably take a discount from this, 250K. In the worst case, right, taking first profit at maybe 200K. We've got the 250K here as well. So 250, 250, and when we divide this by 2, 320. Probably it already starts to make sense to take first profit at 200K and then be out of the market at around 250. And as we go from 200 to 250K, we want to sell more and more. So we start buying at 50, we buy more and more as we go down to 40 and then to 30, and then we sell starting at 200K to be out of the market completely at 250K. And with being out of the market completely, I just mean with our risk on Bitcoin, right? There should always be some kind of allocation just to have a diversified portfolio. The same way we should have some allocation to gold, even if gold is now very, very high relative to the fiat currency base. We should still have 2, 3, 4% of gold in case the monetary system completely implodes. So it always makes sense to have at least some money in an asset. But we should always play around with the weightings in a diversified portfolio. And so when I say to be completely out of Bitcoin at 250K, what I'm basically saying is completely out of Bitcoin from all of our speculative BTC. Having, say, 10 or 15% of Bitcoin in terms of net worth always probably makes sense, because we can never be 100% certain. And so when we can't be 100% certain, we also shouldn't act in our portfolio in that manner that we have sold everything, or that we have 100% of everything in that asset. Of course, there are some slight adjustments to this, right? If your net worth currently is very low relative to your regular income, so let's say if you look at your monthly income and you only have, say, 2 or 3 months saved up, and that's all of your net worth, then you have to be careful, because that fundamentally means you do not need to diversify too much. You can put everything into one thing, and even if that drops by 50, 60, 70%, that's okay, because your regular cash flow, your savings can offset that drop quite a bit. But if you have several years of income saved up, say your annual income is 100K and you've got $1 million of net worth, then you have to be more diversified. Then you have to own all kinds of different things, because then if you then drop by 50, 60, 70%, it will take you a very long time, you know, to get all of that back again. So your regular cash flow could be seen just as another asset that you have, right? Your income, your job income could just be seen as another asset that you have. And the bigger that asset is relative to all your other assets, the more you are already diversified, right? Because your saving from that regular cash flow can offset all of the volatility of the rest. But if your income is not growing in the future anymore, or if it will stop in the future to a degree because you retire, or because it's relatively small relative to your net worth, to what you have in all other assets, then you just have to be diversified more. You have to be more careful, and that's how to go about diversification in general. And so that's why it's very hard to say how much should you have in each asset class at any point in time. But if your net worth is several years of your income, still it probably makes sense to have at least 5 to 10% of net worth in Bitcoin at any point in time. The same way it makes sense to have 5 to 10% of net worth in gold at any point in time. Right? So this is how I go about things. But then, of course, we can adjust those weightings based on where we currently see the market. And that's why we make all of this analysis. That's why we look at models like this, just to find out, are we currently cheap or expensive in a particular asset class? And since this is the Bitcoin strategy channel, I like to focus, of course, on crypto. Crypto is also the most inefficient of all of the markets, I believe. So it's easiest to time. We've got a lot of data on crypto as well. That's why I like it so much. Really appreciate your videos and live streams. Most underrated finance channel for unbiased analysis. Thank you so much for the comment. It's really nice. That's one of the reasons why I like those live streams. It's just because of the positive feedback. We are all suckers for positive criticism. And whenever YouTube videos are published, the communication is much less direct. It's more anonymous, and it doesn't feel that great. But here, right, in live streams, I can chat with you directly. It's much more fun. So yeah, thanks again for everything. Feel free, of course, again, to give this a like. I see it's getting late for some people. The number of viewers is dropping. I try to do these live streams as early as possible. It's now 7 a.m. in Malaysia, but I can see how people in the US might now start dropping, or rather in Europe. Gerhard, why DCA into spot when you can DCA into SMA strategy? Nearly all moving averages outperform. Is a spot hedge against SMA failing? Your thoughts? Yeah, this is just diversification against the SMA strategy potentially failing, right? There's no certainty in anything. And while I like to have strong allocation towards the moving average strategy, I don't want to have too much money in it. And I also want to make sure that in case it doesn't do that well, that I still have something else that's doing fine. And I want to have, in case, for example, with the moving average strategy, right, when we have exposure to decentralized finance applications like Hyperliquid, I want to make sure that I've got some spot Bitcoin that's held as native Bitcoin on a ledger that never goes away, right? Where I really have the Bitcoin and where I'm not just betting on the Bitcoin price. So it's just another type of diversification. You might hear out of this, I'm much more risk averse than it might first seem. I'm trying to take smart risks where I outperform the market, but I still diversify well, because if my net worth was to suddenly drop by 50%, I'd have a lot of headache. I don't want that headache. I want to sleep well and still make enough returns with my investments. Do you think Bitcoin is going to pump up to 71K today? Who knows? Maybe. I am not speculating on the very short term. I think that's too dangerous. There's manipulation short term. A single whale can do certain things where we don't have any influence. Short term, we might have seen a bottom, right? But again, medium term, I'm still rather bearish because we are below the moving averages. There's a good chance that we're going to rally to 80K. But I'm not betting on it because I like to bet on the general macro. I try to bet on rising prices when we dip in a bull market, and I like to bet on falling prices when we rally in a bear market. That's my fundamental way to approach things. Are you wearing the reindeer suit? I was actually waiting for that comment. I've got a little bull mask over here. If that's not worth a like, I don't know what is. Unfortunately, this bull I think is not as pretty as the bear costume. I don't think I have to wear it too often. Once we actually do enter a bull market, then I'll buy something better. But yeah, I needed to buy both, right? I can't just have a bear costume. That's the one over here. Can probably see it better on the other camera here, over there. All right, I've got this one. That's pretty. I like that a lot. And I will wear this again. The bull costume is probably not the best. Even today is positive. We shouldn't zoom too much into the recent and rather bet on the general trend. That's how I personally do it. Yeah. The only reason I clicked was because of the suit. I hope you did not get disappointed, Jungle Boy. Bro, we don't care about Bitcoin. We just want to see you in the suit. There we go. I anticipate already what you're going to write. I'm not just good at predicting crypto prices. I'm good at predicting comments. I appreciate the general mindset videos a ton. All of those videos together have more value than many paid courses. Yeah, thank you so much. I will record more of them. I enjoy doing them as well. Planning to buy a bigger house, maybe not a good investment financially, but good for life quality. I can actually talk about this a little bit. You have to consider always, especially if you've been living in a very small place, say a small apartment, and you then want to upgrade, you have to consider not to upgrade too much, because there is actually marginal negative utility to a house. So I've got my wife, I've got 3 kids, and I've got a domestic helper living with us. And our house, roughly 500 square meters over 3 levels, is already at the edge of being too big. The problem is, once your house becomes too big, everything becomes anonymous. So if you like to be around your people in the house, if you like to talk to them, if you like to be around them, then it's good to have a house that has the optimal size, that's not too big, because then you bump into them, you talk to them. If you have a house that's too big and everybody's always in their own room, then yeah, it's like you have to call them if they come to dinner, or you scream through the house to get them to come. It's not necessarily optimal. So there is marginal utility. When I see those big mansions that are being bought by influencers and by stars, etc., I always think I wouldn't want to live there. Even if I had the money, I wouldn't want to live there, because you never really meet the people that you live with. And yes, they might be good to throw a party, but then you just might to go to a party that owns that kind of house. It's not really great to live in huge mansions. There is marginal utility to this. So when you upgrade your house, yes, it might not be the best investment, but buying property might also not be the worst thing right now. At least there's not a huge bubble in it. At least I don't see it. And you might be able to refinance it once interest rates go further down. So it's in the end, it's still a lifestyle thing. If you can lever it up relatively well with a lot of cheap debt, that's always the best, right? That's how property investments in general make money. You have a lot of debt that devalues over time at a quicker rate than what the monetary than the monetary base. So basically what's happening is you pay maybe interest of 3 or 4%, the value of the dollar drops by 7% per annum, and the delta that you make, right, the debasement minus the interest payments, that's actually what you're going to make in return. So if you just measure house prices versus the monetary base over the very long term, they actually underperform by roughly 2% per annum. Very similar to how gold tends to underperform by 2% per annum over the decades. But if you look at how people make money with property, it's because they have only 10% down and they've got 90% debt, and the debt only costs 3% per annum, and the dollar devalues by 7% per annum, and so they make 4% on 90%, right? And the 10% is just debt capital. They put in the 10% equity, but the 90% that they actually have, that's what makes in the end the money, right? It's say a 4% delta in this example times 9, that's 36% on the equity that you put in. 36% compounded year over year, of course, is quite nice. So this is actually how you make money with property. Make sure if you can pay the monthly payments very easily, if your cash flow is super stable, and if your financing rate is very, very low, that you take on as much debt as possible to take advantage of that devaluation of the debt over time. And of course, make sure that you don't buy too much of a house that in the end you will have to scream in order to get your children to come to dinner, that you're not living isolated lives. Yeah, this is probably something that many people don't tell you when you're buying houses, especially not the property agents that want to sell you the biggest house ever. You mentioned you're in Malaysia. What are the pros and cons of moving there from your experience? The price level is extremely low, so your purchasing power goes through the roof. You're living very well here. If you like driving cars, it's very cheap to add petroleum. The roads are quite nice to drive on outside of rush hours. It's very family friendly. You don't have the drug problem that you might have in Thailand. So there's a lot of advantages to this. The only real disadvantage of being in Malaysia is that earning a living here locally is pretty much impossible if you want to have a good life, because the economy, comparatively speaking, at least let's say salaries are very, very low. So whatever way you have to gain purchasing power, be this through the internet here, or be this through capital you've already acquired and now you just have capital returns that you use, basically you're retiring, right? If you've got some kind of outsized source of income, Malaysia is great. If you want to generate income here, it's much, much harder. I would not necessarily recommend that. If you just want to make money the easy way, and if you want to heads down, go to work and build a career and make your first capital to potentially build wealth with, I would recommend the tougher cities, right? The cities where you're really just focusing on career. I used to live 12 years roughly in Hong Kong. And so in Hong Kong, that's where I built my career. This is where I had an IT management job. I saved a lot of money from that IT management job. On the side, after my main job, I also did a side hustle. I would program for a small company. I would get an hourly payment for that. So I had 2 to 3 jobs at the same time, saving as much as I could, living in a small place outside of the city center. And this is how I gained my first capital that I would then invest mainly in Bitcoin at the time when it dropped. And so that's how I made my first money. And that's probably the easiest way. So you want to be in a country with very high income, where the expenses can also be high, but where you simply just buckle up, where you don't want to necessarily expense much, where you live super frugally for a while to then, once you've got the capital, move to somewhere where you don't have to work locally. So that was my personal plan, and it worked out beautifully. So what kind of places can you use? You can use any kind of metropolitan area. You just have to be okay to live frugally in a small apartment outside of town, and ideally you don't yet have a big family at that point in time. So Hong Kong works, Shanghai works, Dubai works, Singapore works, Zurich works, Luxembourg, New York, maybe London. And of course, very important is that you've got some kind of skill that's compensated well, right? You don't want to be in those places just driving the taxi. You want to work in IT, you want to work in banking, you want to work in strategy consulting. You want to do something that gets compensated highly in those places. You're going to work 80, 90 hours a week through multiple jobs potentially, and then you just save it all as much as you can, and then invest it properly, hopefully with the knowledge here of this content. And then at some point, once you've reached several years of income, you can move to a place where your expenses maybe just get cut in half, like Malaysia. Suddenly, you don't just have 5 years of expenses saved up, but you're suddenly doubling it by moving to a cheaper place. Now you've got 10 years saved up, and that's already very close to retirement, right? If you then still have a remote income source, maybe the side hustles that you did in the past, that's what I did, then you can just live there, right? You've got parts of your expenses saved from your capital, your 10 years of expenses, right? So that makes roughly half of your expenses already covered. And then you've got your passive income, or then you've got your active income through remote work, and then you're covered. So that's, I think, a pretty good approach to go about things. In general, right, I always think once you are roughly close to 20 years of expenses, then you are retired. Then you don't have to anymore do the active income thing. And yeah, there's obviously the problem with lifestyle inflation. There's the problem of growing the family, of getting more and more expenses that way. So even you might consider yourself retired when you're single. Once you have a family, suddenly your 20 years get cut in half again. But that's life, right? That's also worth working for in the end. But that's, I think, in general, a good life planning approach. You try to make as much money as possible in an expensive place where salaries are high, you live super frugally, you invest this wisely and aggressively at the beginning. And then once you are at a certain point, you just move to a low-cost country and try to make the remainder of your income via something active that's remote, and then use the rest with your capital base and supplement that way. Of course, you could do this arbitrage directly. You could try to move into a low-cost country from day one. You could move to Thailand as a single, party every night, and make your money remotely. But the problem is that usually remote jobs tend to not pay as much as local jobs in those expensive cities still. And so that's why you probably will take a longer time to accumulate enough wealth to be able to relax a little bit. So that's why I don't like this digital nomad lifestyle from the very beginning of a career, because you're probably not going to be able to save 80% of your income unless you're really, really good at attracting very high paying remote jobs, then of course, feel free to do that. I think it's a good way, right? It's a good way to reduce expenses to live in a country that's comparatively cheap. Think also about taxes, by the way, right? So if you do these kind of things, especially once they scale up, make sure you've got companies in different places where you then can expense things, where you can then pay taxes in certain places, where you can then potentially also pay somebody else to take some grunt work away from you, that you can then pay that person on company expenses, that you have a bit of arbitrage going on, that you don't pay just the local taxes. What you can also do is then move across countries, right? You can be, say, in 3 or 4 different countries in a year. You're never more than half a year in a particular country, and then you don't have to pay the tax usually. If you're not in a certain country for more than half a year, you usually don't have to pay the local taxes of that country. But then also depends on where you're from, right? If you're from the US, you have to pay the US taxes anyways. So it's a bit more of an individual thing. But yeah. Interesting question, something I haven't talked about much. Maybe another topic for a one-to-one video that I might consider. Let me write this down. Moving to Malaysia and geographic arbitrage. That's how I call it. We still have 100 people watching, still going strong. Thank you so much. When do you think the bull run starts? After we have bottomed out, and that's probably after we have fallen to at least 50k. Very early in Malaysia, yes, that's correct. I like to sleep early. And I like to wake up early. The morning hours are always the best. I get the idea on investing on assets which aren't correlated between them to prevent big swings, but doesn't that limit the upside quite a lot? No, it does not. It does the exact opposite. What you're doing is you rebalance your portfolio. So whenever you've got a diversified portfolio, you are able to then buy the bottom by selling the thing that's currently expensive and buying the thing that's comparatively cheap. So you are able to take advantage of price drops. If you do not have a diversified portfolio, all you can do is you can buy the price drops with your cash flow. But that's it. But if you've got a diversified portfolio and crypto suddenly crashes by 70% and you still have some gold on the sidelines and you sell some of the gold to buy Bitcoin, suddenly those moves matter. And this kind of effect does not necessarily matter as much when your net worth is low, because when you buy the dip just with your savings rate, it's good enough. But if your net worth is several years of your income, buying the dip with your cash flow isn't really going to cut it. It's not going to move the needle. But if you've got a diversified portfolio and you've got things that aren't highly correlated, you can now sell the thing that's expensive with several years of your income and buy the dip with several years of your income. Something you could never do just with your cash flow. So that's why you want to have different asset classes. It's not just to reduce risk, it's to give you the optionality to buy something that has crashed a lot. If you have everything in just one asset class and that asset class crashes, you can't do anything. You can't really buy the bottom besides with your cash flow. And that's only working if your net worth is not yet big. It's a bull suit. Yeah, I think it's good enough, right? A bull suit. In general, we believe in capital preservation and income maxing. Yes, I agree. But of course, we also want to grow our capital, right? Once we grow our capital beyond 7% per annum, we are good. We are getting ahead year over year. Then, of course, everything on top of that is the cherry on top. But we should try to achieve with our portfolio at least 7% per annum to offset the monetary debasement. Anything below that is not good. Only trading a market where you believe we have an edge. Correct. Don't try to beat the Forex market. Stay away from those scams, please. When is the best time to enter Bitcoin, Ethereum, vault strategy? Depends on your time horizon. If your time horizon is very long, you can already start dollar cost averaging in right now. If your time horizon is shorter, you might want to wait until we get closer to the moving average. Given ETH dropped a lot lately, do you think it would make sense to start relative valuation shorts versus ETH? Yes, it might make sense once we are really at low levels. But again, the problem a little bit is that Ethereum, I believe, long-term will underperform. Right, so when we look at ETH relative to BTC, I can't type anymore. ETH relative to BTC, the long-term chart, the long-term trend is negative. Since we moved from proof of work to proof of stake, we are going down in Bitcoin, in Ethereum relative to Bitcoin. And so yes, we could open up relative valuation shorts, go long Ethereum to bet on this bounce. But again, it's a bounce against the general macro. And that's my problem, right? I do not like to buy against the general trend. I rather like to short the tops. So I might close some of that position of Ethereum shorting once we are at the bottom here. But I will not necessarily go long Ethereum. I'll just wait until we go short Ethereum again once we are at the higher level here. When you say you don't hold alts, does this include ETH, XRP, etc.? Yes, it includes all of those. Yes, we think alt season is after a massive Bitcoin rally, which we believe is only possible if we fall another 20 to 50%, then go up 8 to 10x. Correct. 8 to 10x is maybe quite hard ask, even if we're going up just 4x or so from the bottom. Right? Let's say we move from 30k up to 120k. At 120k, we could already see the first rotation to altcoins. Bullhard, yeah, not going to change my name that quickly. Do you believe that the crypto markets have been massively manipulated, including Bitcoin? There is manipulation, but it's mainly in the smaller altcoins. It's too expensive to manipulate Bitcoin. It's too liquid. That's why using the moving averages for Bitcoin is so useful, because the trend is your friend and the trends tend to prevail. And yeah, we've been quite happy with that, right? The problem really, the fundamental problem, in case you haven't seen this yet, is that we do not see any money flowing into the market anymore. Since October of 2023, the stablecoin market cap relative to the money supply tended to go up, and that stopped in October of last year. So no more money is flowing into the space, and that makes sustained growth in crypto prices unlikely. And that's why, besides just the moving average strategy, I believe there's a good chance we go below the realized price. There's just no money coming in. So my base case here, this is the stablecoin dominance, right? My base case is this here, that we might see a bit of a rally in Bitcoin, a bit of a relief rally, right? Those two, the stablecoin dominance at the top and the Bitcoin price, they are negatively correlated. When the stablecoin dominance is low, that means the market is very much risk on. All stablecoins have been deployed. Crypto tends to be at a local top. When the stablecoin dominance is high, that means we are at a potential bottom. We have risen now a lot in stablecoin dominance. More and more people got risk off. And yes, we might get a bit more risk on again. We might see a bit of a bounce, but I do think that there's a good chance that stablecoin dominance will hit the 16% again, as it did during prior bear markets. And so, yeah, a decline in stablecoin dominance and a subsequent increase would indicate slightly rallying price in Bitcoin with a subsequent crash down. That's my base case. I appreciate the live stream. I appreciate the comment. Thank you, Steve. Everybody that comments, even if you just say hello or thank you or appreciate, whatever it is, it helps the algorithm. And of course, if you haven't liked yet, that's also very much appreciated. It will help more people tune in. And thank you for the 105 people that are currently watching. It's an actual mask, guys. It is an AI. The thumbnail, unfortunately, actually is AI. I think the mask is not pretty enough to be put on a thumbnail. But yes, I do have a mask. One reason I think alts can't rally from here is complete interest from retail. Yes, that's correct. And the interest will come back when Bitcoin has rallied quicker than any other asset class. Interestingly enough, the average investor is always interested in the asset that has risen the most. You might have noticed how people around you talk about gold and silver recently, and how last year they talked about AI stocks. It's always the thing that has already risen that gives the attention. And so Bitcoin has to rise for retail to start buying the altcoins again. That's my thesis. The kids need to own rooms, not have to share. Yes, I have the same thing here. Right? I had my own room. My kids all have their own rooms. Still, right? You don't want to have too big of a house with too many useless rooms that you don't need. Watching from Norway here. Greetings to Norway. Many Norwegians here. Yeah, I also have seen a lot of Norwegians from Premium. So I can always see whoever signs up for the Premium membership where the credit card is coming from. And I also see the nationality for people in Telegram that joined the Premium Telegram groups once starting the chat. So yeah, Norway seems to be, interestingly enough, very popular. Same is true for Netherlands. Netherlands and Norway. I don't know where this is coming from. But greetings to Norway. Appreciate you being here. What's your experience airdrop farming? I don't do airdrop farming. It's too risky for me for too little payoff. There's too many airdrop scams, and I don't like to expose my capital to platforms where I do not know if I can trust them. And there's no way for me to vet this properly. If you put in enough time and you don't have a lot of capital, you can probably make quite a bit of alpha from that. But not really a fan of this once you have to grow a bit more capital, like the hundreds of thousands or even millions of dollars. Germany is an underrated holiday destination. Yeah, maybe. I still like Asia a lot. I've been in Asia for a long, long time. Germany is still nice, but the visit is okay. Living there, it's not my favorite place to live. Unfortunately, not anymore. I don't like the weather. Thanks for your videos, Berhard. Finland here and Scotland here. Yeah, okay. So we are through with all the comments. Thank you again for watching. We are now at 2 hours of a live stream. I think this is long enough. Feel free to also, in case you haven't watched the entire stream, to then watch the summary. So I will cut out all the empty space. I will cut out all the M's. There will also be clips. So I'm now asking my editor to clip various portions of this live stream that will be published over the next days. Thanks again for all of your support. Looking very much forward to seeing you in the different YouTube videos. And see you next time. Cheers.